Bitcoin yield higher, and you would rather have more Bitcoin per share because Bitcoin is going up 30% a year, taking on more risk, and the plane then stalls. Or I can put the nose down and say what I want is 15% Bitcoin yield. Wait a minute, you're going slower. No, but I'm going to keep climbing at 15%. It would be equity accretive on a net asset value basis. It would be dilutive on a Bitcoin per share basis. At the end of the day, we said, hey, we want to double Bitcoin per share over 7 years. That implies BTC yield of 10% a year.
You can sell stock and buy Bitcoin at a price that is dilutive to Bitcoin per share, meaning the number of Bitcoin held per share decreases, while simultaneously being accretive to net asset value. This happens when you sell stock at a price above the underlying asset value per share. The equity expands, the Bitcoin per share shrinks. It is not actually a contradiction. It is a feature, not a bug, of how corporate finance works.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Let me address the issue of, MNAV and accretion dilution. Well, like we said, I think we said on one of our last conference calls, if we sell stock to buy Bitcoin below like an MNAV of 1.22, right? If we sell it above, it's accretive. If we sell it below, it's not accretive, right? And then people thought, well, okay, that means that any stock sale below an MNAV of 1.22 must be dilutive. Well, the misnomer was the slide says it's accretive in BTC yield terms. It's accretive on a Bitcoin per share basis if we swap stock for Bitcoin at an MNAV above 1.2, I think at the time. If you look at the business based upon Bitcoin per share, then if we were to sell $100 million of stock and buy $100 million of Bitcoin above that level, we accrete Bitcoin per share. On the other hand, if we sell $100 million of stock and we buy $100 million of cash at that same level, we don't accrete Bitcoin per share. That's BTC yield negative. So when we're at a given trading level, right, whether or not we buy US dollars or Bitcoin determines whether it's BTC yield positive or BTC yield negative. And there are a lot of situations where, like even an MNAV of 2 or 3 or 4, if we sold the stock and we bought cash with it, it would still be BTC yield negative, right? However, what we didn't talk about on that call, which created the confusion, is if the company sells stock at 1.1 MNAV and buys Bitcoin and cash with it, it's still net asset value accretive. Like the assets that the shareholders have per share have gone up. So you can actually increase net assets per share even at a different level. And if the company has $90 a share in net asset value, if you sell stock at $115 a share and then you buy $115 of cash, well, you had $90 of something valuable, now you have $115. So it's actually accreting assets per share. The catch there is you've expanded the balance sheet, right? It's accretive to the equity on a US dollar basis. It's slightly dilutive on a Bitcoin per share basis. So what is the significance of that? Well, the significance is if you're bullish on the market, if you're actually saying Bitcoin's going up 30% a year, then you would rather have Bitcoin yield higher and you would rather have more Bitcoin per share because Bitcoin is going up 30% a year. So if you have a bullish filter on, then you would say sell $1 billion of credit, buy $1 billion of Bitcoin. and you've increased the growth rate of the company. So it's good for growth to maximize Bitcoin per share. But when you did that, you increased the credit risk. Okay, so what you have is a tension between risk and growth. So if you're actually doing a swap, let's come back to this. If I actually sell $100 million of stock and I buy $100 million of Bitcoin, that increases the growth of the company if it's Bitcoin per share accretive. If I sell $100 million of stock and buy $100 million of cash, it decreases the credit risk of the company, expands the capital base, and it slightly slows down the growth rate of the company. Instead of, Bitcoin yield of 20% a year is hyper growth, well, Bitcoin yield of 15% a year is still growth, but it's lesser growth, right? And so in all these cases, what you're doing is you're deciding how fast do you want to grow the Bitcoin business versus how much risk do you want to strip off the balance sheet for the credit. And now here's the most sophisticated idea, and this is what blows people's minds. We are dynamically balancing growth versus risk in the now, like right now. But our models are also considering growth, managing growth versus risk in the midterm and the long term. So when we do the trade, right now, let's say I went and I sold $100 million of stock and bought $100 million of cash. Well, that would decrease Bitcoin yield in the near term. It would decrease credit risk in the near term. It would be equity accretive on a net asset value basis. It would be dilutive on a Bitcoin per share basis now. But it would improve the creditworthiness of STRC, and we could sell $1 billion, or maybe we sell a lot more STRC in the future, and it would increase the forecast for Bitcoin yield next year. And so sometimes what you're doing is, it's kind of like, I have a plane. I can pull the stick back here. This is 30% Bitcoin yield, but it's taking on more risk, and the plane then stalls. Or I can put the nose down and say, what I want is 15% Bitcoin yield. Wait a minute, you're going slower. No, but I'm going to keep climbing at 15%. And so what we want to do is find the right balance of risk versus growth this week, this year, this decade, right? We could say 4 years out, right? And so a lot of times what happens is we put out announcements every week. So it's like, well, this week, BTC yield fell by X percent this week. And credit risk also fell by a certain amount, and it was accretive to the equity. It was on a dollar per share basis, but it was dilutive on a Bitcoin per share basis, and that's what happened this week. Why did we do it? Because we thought that this year it would be better, and in 4 years it will be best. If what we wanted to do was optimize one side or the other, it's like, well, we would just raise infinite cash. You can imagine if we raised infinite cash, well, it could be, for a while, it would be dollar accretive. We'd have a US dollar yield or a NAV yield. But then people would say, well, where's the growth potential? I'm not accreting Bitcoin per share. And so then the equity premium would disappear. And so you're basically turning off the Bitcoin engine if you basically get too risk adverse. But on the other hand, if you go to the other extreme and you're too equity positive, or you're too, I'm not going to say equity because all these things are good for the equity, but I'm going to say Bitcoin positive. If we basically ran the business to maximize Bitcoin yield, and we the way to maximize Bitcoin yield, Natalie, would be we go borrow $10 billion in debt, and instead of having $6 billion in debt, we have $16 billion of debt. And then we would have massive Bitcoin yield, we could borrow the debt at a lower dividend rate, whatever. But then the problem is the credit risk explodes. And so the company is balancing Bitcoin yield versus credit risk. And of course, we're not really making a decision to optimize for this week. Like we're announcing every week, right? The shortest period we would ever think about is probably 1 year. And then we'd be thinking out probably 4 years. So anywhere from 1 quarter to 4 years are periods that we're considering. We announce every week, and the prices and the market reacts every minute. And so on Twitter, you've got people, they're like, oh my God, the company lost $10 billion in the past 2 weeks. Well, actually, Bitcoin traded down $20,000 in the past 2 weeks, right? They're just marking it to market every minute. So Twitter and the mainstream media, they have to write a story every day, and so they have something interesting to write, and that makes us interesting. And then they might say, well, this looks like it's dilutive on Bitcoin per share, but they said they want to grow Bitcoin per share, and so they, must be hypocrites. That's a good thing to say. But at the end of the day, we said, hey, we want to double Bitcoin per share over 7 years. That implies BTC yield of 10% a year. Well, we're at 12 to 13% right now. We're already ahead of that. And so, certainly a decision to improve the credit of the business or to improve the balance sheet or the credit capacity of the business that results in a near-term negative Bitcoin yield doesn't mean that we're not committed to growing Bitcoin per share. It just means that we need to do it over a quarter. And the same true with Bitcoin sales. It's like we might sell some Bitcoin in 1 week, but we will generally accumulate Bitcoin every quarter. So we're a net buyer of Bitcoin and we're generating net Bitcoin yield. Every other company in the world reports financial results quarterly. So you wouldn't even be able to talk about this because if we didn't put out the 8Ks every week, there'd be no news. And at the end of the quarter, we say, oh yeah, Bitcoin yield is up this much and the Bitcoin number is up this much. And by the way, we did all these trades. There would be about 100x less news. We'd be less interesting. Probably we'd have less Twitter trolls, that are interested in us. But we don't think that's the right thing for the business because we think that weekly transparency is beneficial to the credit investors, the derivative investors, the options traders, the equity investors, and we want to feed them all of this transparent information. So we update the capital structure once a week, and then we publish to our website, and then we update the website every 15 seconds. And it's a never-ending, endless stream of things to talk about.
This is the complementary relationship that Saylor describes. Bitcoin capitalism and Bitcoin fundamentalism are not in conflict. They are symbiotic. Institutions bring capital, political power, and scale. Fundamentalists provide ideological legitimacy, network security, and the philosophical foundation that makes Bitcoin resistant to attack.
I think the fundamentalists would like to see a world where everybody custodies their Bitcoin, runs their own node, and uses Bitcoin as the medium exchange, the store of value, the unit of account. And we don't need banks, custodians, credit, there's no currencies, all of these other things. And that's an idealistic notion. In 17 years, we haven't arrived at that we don't seem to be close to that. I don't think that's happening in the next 5 to 10 years. So our view is the fundamentalist ideology is really important to the soul of Bitcoin, but taken too far, if there's a rejection of nation states, currencies, governments, bonds, equities, credit instruments, money managers, and funds, then what you've done is you've locked out 99.9% of all of the capital in the world. And it's possible that 1% of the capital in the world will embrace this idea. We might be 10x more successful. They're pure Austrian, maybe pure ideologues. But it's pretty clear that 99% of the world will never, ever embrace this idea. Not in the next decade. I'm not going to opine on 100 years from now. But in the next decade, 99% of the world, they want bank accounts, they want money markets, they want credit instruments. It's pretty clear that if you ask 100 people, would you rather have 40% volatility and 40 AR Bitcoin and hold it a decade with no cash flows? Or would you rather have a bank account that pays you 10% with no stress? And no stress, no volatility, and just 10%. It's pretty clear that 99 out of 100 people would take the bank account that pays 10% rather than the Bitcoin that pays 40. Even though theoretically 40% is better than 10%, but and this is not a supposition. I'm not hypothesizing. We know this for certain. We've actually run the focus groups. We talk to people. So I respect the fundamentalist, but the capitalist, Bitcoin capitalist view is we need to attract capital into the network to grow the network. There's no way for the network to grow from $1 trillion to $10 trillion to $100 trillion unless we actually get new capital to flow. The reason Bitcoin went from 10,000 to 100,000 is because the ETFs invested 100 billion, because Strategy invested 64 billion, because we got 30 billion from other institutional sources. If that money didn't flow, Bitcoin would be trading 5,000 or 10,000 a coin right now. So the next level, to go from 100,000 right now where we are to $1 million a coin, we need capital, and that means credit. And we either need digital credit that companies like Strategy and Strive create, or you need bank credit, which gets created by Morgan Stanley and Citigroup and JP Morgan. If they don't enter the market, then Bitcoin stagnates amongst the fundamentalists. And if it stagnates, at best it becomes 0.1% of the world's capital structure, and at worst it stagnates and crashes and fails. Because if it doesn't keep growing, the people that are actually defending Bitcoin in Washington, D.C., that talk to, the Treasury and the SEC and the CFTC and the Federal Reserve and the White House and Congress and the Senate, those are corporations, right, that are actually creating the Bitcoin, backed securities, whether it's an ETF or a Bitcoin-backed equity or a Bitcoin-backed credit instrument or a Bitcoin exchange like a Coinbase, right? You have to have political power if you want to protect and legitimize your asset. Otherwise, you get taxed into oblivion or regulated into oblivion, like in China, where they just make it illegal to trade it, right? If it becomes illegal to buy Bitcoin in the United States, that won't be good for the fundamentalists, right? You actually need actors with legal and political power to defend the Bitcoin exchanges, defend the Bitcoin businesses, defend the Bitcoin custodians. And right now, what we're doing is we are transforming some percentage of the credit market into digital credit. If we transform 10% of the credit markets, that would be $30 trillion. Now, it would be $60 trillion over time. So if you want Bitcoin to become 500, if you want it to 500x, if you want $20 million Bitcoin, then the capital will have to flow from the credit markets, right, one way or the other. And so our view is, we're powering up the network, we're building a bridge between the credit markets, and you could close your eyes and wish they would go away, but they're not listening to you. I mean, every credit investor, a private credit, junk credit, mortgage-backed credit, municipal credit, sovereign credit, bank credit, money market credit, you name it, they're not going to Twitter reading the Bitcoin fundamentalists and saying, oh, I guess I should just get rid of it all and buy Bitcoin. They've had 17 years to do it. They're not doing it. They're not going to do it. So what we need to do if we want to change the world in a constructive way is we need to engage with them. We can probably persuade them to convert somewhere between 1 and 10% of their capital into digital credit, put it into Bitcoin, and make Bitcoin successful. We're doing that in the equity capital markets as well. We're doing it in the derivative markets as well. If we want Bitcoin to win, then we need to defend it politically, and then we need to power it economically. And there's no way that you can obtain the political influence without creating corporations that have economic strength and credibility. So I think that the Bitcoin capitalists are actually powering up the network, and they're empowering the Bitcoin fundamentalist. If you are a Bitcoin fundamentalist and Bitcoin goes to $1 million a coin, you're much more effective at pursuing and defending your values than if Bitcoin was $1,000 a coin. And so I think that even people that choose not to buy digital credit or digital equity or wrapped Bitcoin by an ETF, they're all the primary beneficiaries of the actions of the BlackRocks and the Strategies. BlackRock and Strategy collectively are trustees for about 7.5% of all the Bitcoin in the world. You know, that means 92% of the Bitcoin in the world is worth 10 times as much. Not, in those systems. So I think it's a very complementary relationship.
Every Bitcoin ETF that accepts $10 billion in flows, every corporate treasury that accumulates Bitcoin, every credit fund that issues Bitcoin-backed instruments is a brick in the wall that makes Bitcoin too big to fail.
If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.